Hi, everybody. Welcome to join our webinar today. Okay, we are still waiting for more of you to join in. We'll take just a moment to wait until all of you are into our webinar room. Okay, I believe you all can see my screen right now and hear me. If you can see my screen and hear me, please click raise the hand button. Okay, on your screen you have a raise the hand button. If you can hear me clearly and see the screen, please click raise the hand button. Okay, awesome. I'm seeing many hands right now. Okay, so it means that the internet works fine, voice works fine, and then the screen works fine. Okay, now first of all, thank you everybody for joining our webinar today. Now, Kenanga has arranged a series of webinars for you to enrich your life in 2020 in view of this market volatility. So, allow me to introduce myself. My name is Shane Chu, and I'm speaker for today. And today our topic is how to use daily leverage certificates to maximize potential returns. Now, this topic may sound a little bit uh, advanced to you because I'm sure not many of you have heard of daily leverage certificates because it's a fairly unknown product, especially to the Malaysians. While it is widely known in Singapore because it's listed in Singapore, but it's not so known in Malaysia. That's why Kenanga wants to bring this to you so that we can increase your knowledge and the financial intelligence so you know how to use these structured products to meet your financial objective. Now, this program is brought to you by Kenanga Investment Bank and also managed by us, Wealthford. Okay, let me go to the next slide. Now, before we move on further, I just want to do a bit of disclaimer, which is whatever we share in this webinar is only for educational purpose. In no way that I give any buy or sell signals to any DLC that we discuss in detail. Whatever presents is only presenter view, which is my view. So I don't give any buy or sell call. So you have to waive the speaker and the Kenanga Investment Bank for all the liabilities that incur. Okay, so whatever we do is only for case studies only. So you're 100% responsible for your financial decisions. Now, this is the webinars that Kenanga has arranged for you for the whole year. Of course, we first start with a very exciting topic because now we are coming to a very volatile market situation. So we will first start with a daily leverage certificates, how to use this tool to maximize the potential returns. Then, following 2 weeks later on Thursday, we will have another topic called money in trends. So this is a topic to teach you how you can do trading by following the big trends. Then next month, we will have Derek Tan to talk about is the 11th year US bull market finally coming to an end. I think this is a topic that will excite everybody. Then we have a bargain hunting on a post-COVID sell down, which is another topic that I believe will benefit many of the people here. Then we have a whole series, including a Chinese webinar in the month of July. So we have tentatively put the dates here, but it's subject to change. Mostly is the Thursday, except in May we have to do it Tuesday because it's very close to Raya. So just remember that these are the dates, but we'll remind you in the email so that you can join. Okay, so remember, if I send you email, please open the email. Okay, now it's the first time you see me, Shane, online, then thanks for joining us today, and we will share more information with you. Just remember, if I send you any email, just open the email so that we can keep you in the loop of upcoming Kenanga webinars. Now, allow me to introduce myself a little bit. I'm a financial speaker and trader and investor for 10 years of experience trading and investing in local and international stocks, ETF, and currency. And I don't want to blow my own horn too much. So basically, I have about 10 years of experience teaching about 10,000 individuals in the area of stock investment through 200 investment events and webinars. Currently, I'm frequently invited to the radio station and TV to talk about the market, talk about the outlook, and also talk about personal finance and investing strategies. Okay, so that's a little bit about my background. I have traded a fair bit of structured products. I've traded inverse ETF and also leverage ETF. So today I'm going to share my experience with you in DLC. So what we're going to cover today is firstly, we're going to learn what is daily leverage certificate. Okay, it may be very new to you, but no worries. Today we're going to walk through the product, dissect the product for you so you can understand inside out what this product is all about. Secondly, we're going to learn how the DLC works. Then thirdly is we're going to learn the usual trading strategies and examples of how to use DLC to make money and to meet your financial objective. Now, fourth is to understand the compounding effect of DLC. This is very important because the compounding effect will work in your favor or against you in different market scenario. And then fifth is something unique about DLC, which is the airbag mechanism, which I will walk through with you later. It's a bit technical. And six, we're going to understand is cost and fees. What are costs and fees in trading daily leverage certificate? Now, before we begin, I think it's very important for us to take a look at the market. Now, how many of you feel that we are very bullish right now? I guess not many. Then how many of you feel that we are very bearish right now? If you feel that, you can raise your hand. If you feel that it's very bearish, click raise hand button. Wow, I'm seeing a lot of hands put up right now. Okay, it looks like market is very emotional. Every headline I see that is leave it down. And then Dow Jones is down how many points? So let's take a look at the market. Let me go to the market, okay? So this is the Dow Jones Industrial Average chart. So let's see whether it's bullish and bearish now. Huh? If you look at the past so many years, they've been on a steady uptrend, right? So the raging bull now finally got a little bit tired. And then now it breaks the 200-day moving average. And it appears that the downtrend line is also broken. Huh? You see that this is the downtrend line. It's already broken. Okay, and then it also break below the 200-day moving average. So it looks pretty bearish at the moment. And then this is the 30 biggest company in America. Let's look at the S&P 500. Okay, let's take a look. This is the 500 largest company in America. Is it downtrend? Yeah, it is still, it is on an uptrend, but then now it has also broken down the 200-day moving average. If you look at the trend line, I'm sure that you have seen that it's also broken down the trend line. In fact, it's still trending down as of the moment. So if you look at the NASDAQ, okay, NASDAQ 100, okay, the 100 largest tech company listed in America, it also breaks down for the 200-day moving average. 200-day moving average is a very important sentiment for us to know whether the market is bullish or bearish. Now, usually when the 200-day moving average is broken, it means that the market has turned bearish. And when the price has fallen 20% from its peak, it means that we are in a technical bear market. Now, yesterday, our Dow Jones has broken down the 200-day moving average and also fallen 20% off the peak. So it means that we are now in a bear market, technical bear market. Okay, will it go down further? I am guessing as of the moment, I think that the risk is very high that the indices will still trend down further, not only in the developed market such as the US or Europe, but also in emerging markets such as China, such as India, such as Malaysia, and also Southeast Asia. Okay, many of the countries today I read that have also hit the limit down. where the trading was suspended. So the sentiment was pretty bearish right now. So what you can do to protect a portfolio is to hedge, okay? But unfortunately, if you notice, many of the safe haven asset, for example, the gold, for example, silver, which is the precious metal category, for example, US treasuries, which are considered a safe haven, actually was whacked down, okay? If you notice that gold and silver, as market crashed, right, they did not go up so high. The fearers, okay, the market go down, right, gold and silver will also be whacked down. Why? That's because there are many funds, especially hedge funds, which have which are very long in terms of they have a lot of long positions in the market, in the equity market. They were having a margin call, and also many retail investors also have margin call. So because of all these margin call, they are forced to divest their holdings in the precious metal, and also forced to divest their holdings in the US Treasury. So it caused that the US Treasury yield to spike because there's a sell down in the US Treasury, because they are forced to sell down their hedging portfolio, which is in US Treasury and in the precious metal, to cover their margin call in the equity market. So you see, even the traditional safe haven asset also fall when the equity market fall. So it does not mean that when the market falls, safe haven asset will go up. So this correlation is a bit intriguing to us, because when the equity market fall, which the risky asset fall in value, the safe haven asset also fall in value, including US treasuries, including the gold and silver. Yesterday, we see the US Treasury yield also spike because there was a lot of margin calls. Okay, so now, in this scenario where when the safe haven asset sometimes is not inversely correlated to the market, what you can do. Now, one thing you can do is look at the structured products. Okay, one thing you can do is to look at the structured products. So in Malaysia, what you can do, you can trade put warrants. You can buy a put warrants. You can short the futures on FKLI. So these are some of the things that you can do, or you can do IDSS short selling. But IDSS is only for intraday. So, but if the market falls so much that some of IDSS may be suspended as well. But the other thing that I feel is very interesting that you must know is this thing called DLC. Okay, daily leverage certificate. It is not listed on Bursa Malaysia, but it is listed in Singapore Stock Exchange. So that's why not many of you have heard this before. So today, I want to congratulate you for joining this webinar where we dissect this product step by step. Okay, now, what is the daily leverage certificate? Now, daily leverage certificate is a structured product. It's a leverage product that's linked to an underlying asset. Okay, so in times of bear market where sometimes safe haven asset do not perform, if you hedge your portfolio using DLC, it will likely to perform. Okay, so listed and trade on the SGX like a stock, so it's very transparent. It is traded on the SGX like how you would trade a stock. Is very simple. And third is each DLC is a separate trading counter. Okay, so what does it do? DLC give you a fixed daily leverage. Okay, you can either choose 3 times leverage, 5 times leverage, or 7 times leverage, or you can choose a negative 3 times, negative 5 times, and negative 7 times. Negative 3 and negative 5, negative 7 means that it's inverse. Okay, so you mean you go short. So all this DLC is linked to an underlying asset. Okay, it provides a daily leverage to an underlying asset so that you can get maximum exposure with minimal capital. Okay, so it's traded on the SGX like a stock, and then don't worry about the liquidity because the liquidity is provided by the designated market maker, and in this case, the market maker is SocGen. It's a European bank, so they are a very big European bank in Europe. So they provide the liquidity in the market. So don't worry that you can't buy and sell because they are designated market maker here by SGX. They are also the only issuer. In Asia, in all over Asia, in Singapore, it's the only place you can find daily leverage certificate. And then the daily leverage certificate issued in Singapore, all 97 of them are issued by SocGen, which is a European multinational company. So they are big companies, so don't worry about them. So Singapore is the only place where you can trade daily leverage certificate. Okay, now here is a little bit about the history. So in July 2017 is the first time that a DLC was launched in Asia. Now in the past, DLC was introduced in Europe and is widely accepted in Europe. And now it is traded in Asia. You can also find it already. And then we see that the interest has picked up because of its simplicity and its transparency. People like these two ideas. So when DLC was first launched in Asia, the leverage given was 3 times and 5 times on index. So the underlying asset are index. Okay, and then in January 2018, which is 6 months after this, 7 times DLC was launched. Okay, and then we see even more interest when 7 times DLC was launched. And then in the same year, in November, the first batch of the 5 times single stock DLC was launched. And then a few months later, in February 2019, second batch of single stock DLC was launched. And then in July 2019, the third batch of single stock DLC was launched. So this is how the DLC has evolved in Asia. And Singapore remains the only exchange that has DLC right now. But of course, as DLC pick up in popularity, I would assume that in the next 1 or 2 years, you will see that more exchange will have DLC. So this is the daily leverage certificate outstanding values. The source is from SGX. You see that when it was first launched, it was probably in March 2018, the outstanding value was probably, I estimate about 2 million Sing dollar. But then as you see until now, as of October last year, we see that the outstanding values has already reached 22 million Sing dollar. Okay, so you see that the interest in participating in DLC has spiked up with the launching of like 7 times leverage, and then of single stocks. Okay, initially the index, the underlying asset is the index in Singapore. Then we have index in Hong Kong. Then we have a single stock of Singapore, and then single stock in Hong Kong. Okay, Hong Kong listed stock. So these are the trend of DLC. More and more people like to use DLC as part of their financial tools and instruments to reach the financial goal. Now there are 2 types of DLC, which is daily long and daily short. So if you feel that today it is very bullish because of the bullish sentiment, or maybe because the Dow Jones or the American market this morning actually was very bullish. So when Asian market open, you want to be bullish, you feel that sentiment is all right, you can go long in DLC. Okay, so you buy a long DLC. So if you wake up in the morning and you realize that the US market is actually on a downtrend, and then you feel that today will go down even further, and you're very bearish, what you can do is you buy a short DLC. Okay, you don't have the short sell, but you need to buy a short DLC. Okay, BLC is constructed using exchange traded notes, so you don't have the short sell the product. You just need to buy the short DLC to get the exposure of the short exposure. Okay, to buy the short DLC to participate in the short exposure if you feel that that day the market will be bearish. So now, how DLC can provide you leverage? And then DLC provides a fixed leverage. I mean, the leverage is fixed. So this is the formula. We use the daily percentage performance of underlying asset times the times of leverage is equal to the daily percentage performance of DLC. Now, for example, if your underlying asset performs, let's say, up 1%, and then you buy long, let's say it's 5 times, so your daily DLC will perform 5%. Conversely, if the underlying asset increases by 1% in value, but then you are actually shorting the asset because you buy into a 5 times short DLC, then your performance will be negative 5%. Okay. Now, this is an example. If the underlying asset is $25, and then on that particular day, it go up to, so this is the closing price of day one, $25. In day two, the closing price become 25 and 50 cents. Okay, so on that day, the underlying asset go up by 2%. So in other words, what happened? If you have a DLC 5 times long on underlying asset A, and also a DLC 5 times short on underlying asset A. So for the long one, okay, you get 2% times 5. You get 10% gain on that single day. For the short one, you get 2% times negative 5. So it's equivalent to negative 10% return to you, which means you lose 10% of value for whatever amount that you invest in the DLC. Okay, does that make sense? Is everybody clear so far? All right, I see a lot of hands. Okay, now let's move on. Very simple, right? Now, how to calculate daily profit and loss? So, for example, let's say the 100 underlying asset is 100, and then in day two, you got the 101, so it's up 1%. So if you invest 1,000 Sing dollar, then it will go up by 7%. Because why? You buy into a 7 times long DLC. Okay, straightforward, right? So you use 7 times 1%, you're up 7 times. Conversely, if you buy into a 7 times long DLC, and then the asset is actually down 1%, okay, in day two compared to day one closing price. So you actually is down 7%. Okay, clear, right? Very simple. So your 1,000 Sing dollar will drop by 7% to become 930 Sing dollar. Now, if you buy into a short DLC, okay, if you anticipate that the underlying asset will depreciate in value on that particular day, you buy into a short DLC 7 times, $100 on day one closing price, and day two it become 98. So the actually share price down 2% because the underlying is down 2%, and you go short 7 times, your asset is up 14%. Okay, 7 times 2, 14. So your 2,000 Sing dollar investment into the short DLC 7 times will become 2,280. Now, if you got the direction wrong, if you think that you feel that it will go bearish, but then on the other hand, it go bullish. Okay, from 100 Sing dollar, the underlying asset become 102 Sing dollar. It's up 2%. So your 2,000 Sing dollar will go down by 14%. Okay, because you use 2% times negative 7 times, you get negative 14%. So your value of the investment will go down 17% to 1,720 Sing dollar. Okay, clear? Now, so in short, DLC is very simple because it uses fixed daily leverage with easy pricing formula. Okay, all this pricing formula will be calculated by the issuer, and then to give you a fixed daily leverage. Now, the daily leverage is fixed. Okay, unlike structured warrants, whereby the leverage could change. For DLC, the leverage is fixed. Okay, so it's very simple. If you buy into a 7 times long DLC, you give you 7 times. If you do short 7 times, it will give you negative 7 times. Okay, 5 times means 5 times. Negative 5 times means negative 5 times. So it's very simple and fixed. Secondly, transparent, listed on exchange. So the buy and sell, the B and R is quoted by the issuer. So it's very transparent. And then you can participate in bull market and also participate in bear market. You can go long and short at ease, okay, without worrying if you short sell, whether you need to cover back your shorts or not, So this is a good thing about structured products. It can give you the kind of leverage that you need, and it's very easy for you to participate in the bull market and also in the bear market. So what is the comparison between DLC? You might ask me, Shane, what is the difference between DLC versus structured warrants, or maybe versus CFD, okay? Or maybe versus margin trading. Okay, now, so here are the differences. Number one, DLC are all exchange traded, except CFD, which is the OTC market. Okay, DLC structured warrants buying stocks are exchange traded, whereby CFD is OTC. And then DLC, is there any risk for margin call? The answer is no. Okay, there's no risk for margin call, zero risk of margin call. Okay, and then if you buy shares on margin, then yes, you have a margin call. Structured warrants, of course, no. CFD, yes. Maximum loss. Can you lose more than the amount that you invest in DLC? The answer is no. Okay, you can also only lose up to the amount of money that you invest in. Okay, it's like also like leverage and inverse ETF. You can only lose up to the maximum that you invest in. Buying stock on margin, yes, you can lose more than you put in because there's a margin facility in it. That's why you can lose more than you invested in. Structural warrants, no. And then CFD, yes. Okay, in DLC, do you have time decay and implied volatility factor? The answer is no. Okay, you don't have any time decay and implied volatility factor because they are not structured using options. Whereby structured warrants, because the product was structured using options, so that's why we have the Greek factors coming in, the delta, okay, the theta, okay, the time factor, the implied volatility, and so on. So there are the Greek factors that come in. So that's why you have time decay and implied volatility that can affect the value. Even though you guess the direction correctly, maybe because of time decay and then implied volatility, so you will actually lose money. Okay, whereby for DLC, there's no time decay, so the cost is constant. The cost is constant. So that's why there are more and more investors in Singapore that like to use DLC to hedge their portfolio. Okay, so these are the difference. Now, how can I use the daily leverage certificate? Now, you can use it for day trading where you want to capture intraday movements of the underlying index or stock with less capital. Okay, for example, if you want to have 100% exposure, you just set aside maybe 20% of capital, and then you use 5 times leverage, then you can have 100% exposure with less capital and can do day trading. And swing trading is a second strategy where you can use in DLC. If you, based on your technical analysis or events that you anticipate, you think that the index or the stock will go up or go down in the coming days or weeks, then you can go into the DLC and hold it for a few days to a few weeks. Now, DLC is not for long-term holding. Okay, I will explain to you later. So for swing trading, for a few weeks, maybe up to 2 weeks to a few days. Okay, and third is you can use hedging. Now, hedging is something that I feel that we need to emphasize, especially in a market where it's very volatile, in a market where it's a bit more bearish bias. For example, if you have some stocks, right? This is how I usually do. I don't usually trade structured products. I use structured products for hedging most of the time. Okay, so if I have some stock positions and I'm afraid of the short-term market corrections, then I can allocate a small portions of the my portfolio capital to go to the structured products. For example, for whatever reasons, I feel that the holdings, I don't want to sell my holdings because I want to because I feel this stock is actually still quite I'm quite optimistic on the stock. For whatever reason, I feel that I want to hold on to the stock. What you can do is you can allocate maybe 5 to 10% of portfolio. Of course, this is my strategy. It's my strategy, so up to you whether you want to learn or not. I can allocate 5 to 10% of my portfolio to go to all these structured products to give me the inverse exposure. Okay, so if the market go down, my portfolio may take a 10 or 20%, and then 30%, but then my structured products could deliver me multiple return, okay, multiple fold return, and then that will cover back my portfolio value. So my portfolio value do not suffer so much. Maybe it's only down 5%, or sometimes it's break even. So I can use structured products for hedging. Okay, now unlike structured warrants where you have time decay, accelerated time decay when it's closer to the expiry date, DLC is fixed. So there's no time decay factor for you to worry about. So it is safer for you to do as hedging. But of course, DLC also give quite high leverage. You see up to 7 times. So if you do the direction wrongly, then the whole investment could go off one. Okay, so you also need to exercise caution when you go to DLC. So it is a structured product, so you must know the risks involved. Okay, so in hedging is you can set aside 5% or 10% of your portfolio to go to buy a short stock or short indices kind of DLC, so that when your portfolio suffer maybe 20-30% loss, your 10% or 5% could actually gain in value. So this is some strategies you can use for DLC. For people who are day trader, you can use DLC to get the return that you want to get. For swing traders, if you feel that this event or this COVID-19 or this oil crash could last a bit more longer, you want to do swing trading, you can use short DLC. Okay. Now, for the tick rule defined by SGX, so if the DLC is priced between 0.1 cent to 19.9 cent, the tick size is 0.1 cent. Okay, see carefully, it's not 1 cent, it is 0.1 cent Sing dollar. Okay, if the DLC is priced between 20 cent to $1.99.5, the tick size is half a cent. Okay, and if the DLC is priced $2 and above, the tick size is 1 cent. So we get a bit more technical now. So the designated market maker, SocGen, will provide investors with continuous liquidity. Okay, so whenever you want to buy, they will give you the price. Okay, they'll give you the ask price. Okay, so they provide bid and ask quote for you, and then the liquidity. But bear in mind, this is one thing very important. Liquidity is only provided for the trading during the trading hours of the underlying asset. Now, because just now I show you that the DLC has underlying asset in stock in Singapore and also in Hong Kong. So for Hong Kong stocks, the liquidity provider will only give you the quote from 9:30 to 12, where the Hong Kong stocks are open for trading, and then from 1 to 4. For Hong Kong indices, it's 9:15 to 12, and then it's 1 to 4:30 p.m. So in between, there are 1 hour break from 12 to 1. But if you buy Singapore underlyings, then of course 9 to 12 and 1 to 5. So it will continue. So there's no disruption. Okay, so this is something that you need to remember. So if you buy or if you want to buy or sell the DLC after for the Hong Kong stock indices after 4:30. In the case of Hong Kong stock, maybe after 4, then the liquidity provider may not be able to give you the bid and ask, because the trading hours for the underlying asset is already over. So if you manage to buy or sell this DLC during the trading hour, after the trading hours, then you'll probably buy from the other person who hold the DLC. So the price may not be fair. Okay, the price may not be fair because the DLC price is calculated based on they have a pricing formula to calculate the fair price. Okay, so this is something that you need to be aware of. But if you trade the Singapore underlyings, then it should be fine. Okay, so what are the costs and fees charged by the SGX? And so these are the thing. For DLC, is 0.001%. It is much lower than stocks. For clearing fee, is 0.04%. Okay, it is much lower than stock. So for brokerage fee, of course, it's determined by your broker. So check with your broker. Okay, in short, DLC is cheaper for you to buy and sell, and then it is more cost effective. Now, how much does the DMM charge you? The designated market maker charge. Now, the cost and the fee is charged by the market maker in their bid and ask quotes. Of course, the issuer also need to make some money. So of course, the cost and fee will charged by them, and it's all priced in the bid and ask. So there's no separate fee that you need to pay. So this is an example of bid and ask. Okay, now because the price of the DLC is $1.81.5, so the minimum tick size is half a cent. Remember, so the bid is $1.81.5. The ask is $1.82. And then this is a cost and fee breakdown. To give you some example. And the costs and fees are only charged if the DLC are held overnight. So if you do day trading, the market maker won't charge you money. In fact, if the market charge you, the cost is also quite minimal. It's not a lot. Okay, so if you take 5 times long DLC on stock A as an example, assuming that the DLC value was 1.5, okay, $1.50 previous day, and the stock moved up 1% today. So if stock moves up 1% today, that means if the stock moves up 1% today, that means that the DLC go up 5%. Okay, so DLC price $1.50, stock price go move up 1%. That means the DLC price go up by 5%. Okay, now so the DLC value before fee, by right, the DLC should go up from 150 to go up to 157 and 5. Why? Because 1% of 150 is 1.5 cents, correct? 1.5 cents times 5 is 7.5 cents. So that's why your DLC now is worth 150 cents plus 7.5 cents, so it becomes 157 and 50 cents. Okay, so and then the DLC value after fee. So by right, it should be $1.57.5, but then because there are fee imposed, so how much the fee imposed is actually 0.00582 is about 0.038%. How do you get the 0.038%? You get this all add up. Okay, the rebalancing cost, the daily funding cost, the gap premium cost, and management fee. Okay, now of course this is very technical. I don't want to cover this. If you want to know more, you can go to the issuer website or the Singapore Stock Exchange to download the brochure, so you know what all this means. Okay, so if you add all these costs, okay, if you add all these costs, and then you get 0.038%, you get 0.038% times with this amount of value. So total you need to pay 0.0058 so you need to pay this much. Okay, so so the DLC value after fee is only $1.57 and 4.4. Okay, so there's not, so it is very the fee is fairly insignificant. It's very minimal, so you don't have to worry that the cost is very high. And if you do intraday trading, then of course this fee will not charge. This fee is only charged if you are held overnight, where they need to do rebalancing and where they need to pay for gap premium. Okay, now of course the example above is specific to a 5 times long DLC on stock A only. Cost and fee vary from product to product depending on several factors, including the underlying asset, leverage, and whether it is a long or short DLC, which will need to be factored in. Everybody clear? All right, so let's move on. Now, what is unique about DLC compared to structured warrants and other structured products is that it has this airbag mechanism. So what does this mean? Like the name airbag suggests, it means that it serves as a protection of sort. So the airbag mechanism is a very technical thing. It's a mechanism that is built into the DLC. It's designed to reduce the exposure of the daily leverage certificates to changes in the underlying asset in case of significant adverse movement in the underlying asset during the day. Now, if that day suddenly, if the share price plunge a lot, and you are actually on the opposite direction, actually you're long, the share price plunge a lot and you're long, then you could your portfolio could suffer a huge loss. You get what I mean? Let's say if your portfolio, if you go long 5 times, okay, you go long 5 times the stock, for whatever reason, because of bearish sentiment or negative impact to the company, then you go long, the share price dropped 15%. And because you go long 5 times, the share price dropped 15%. When the underlying drop 15% and you go long, you actually lose 75%. You get what I mean? Because you get 15% times negative 5 times, because so you get negative 15% times 5 times, so you get negative 75%. So your allocation for the portfolio could actually go down negative 75%. That's why I want to suggest that for structured products, right? For me, I hardly bet lah, because I'm not a gambler. I am an investor. Okay, so I don't use structured products to bet and gamble in the market. Okay, so because if you see, you have the risk of losing 75% in your portfolio. No? So, and what the issuer wants to do is to protect you from this adverse development. So if you get the direction wrong on a single day because of excessive leverage, you might actually lose out significant portion of your portfolio. Okay, now of course, if you set 100% of your capital go into one counter, then you will lose a lot. Of course, if you just set like you have 100,000, you set like 2,000 Sing dollar to buy the DLC, then you only lose 75% of the 2,000 Sing dollar lah, huh? You get what I mean? So don't allocate too much don't allocate too much of your portfolio into the DLC, in my opinion, unless you want to gamble. If you want to gamble, then I can't stop you. If you want to really invest to get sustainable gain, then of course you just set aside a certain portion for hedging. Then now, in the event of adverse development, the airbag mechanism will aim to protect you from all this adverse development. Okay, so when so just imagine like a limit down. Okay, when suddenly the share price, like the S&P 500 or the indices, when it's down 5%, right? The stock exchange will actually cool down the period for 15 minutes before it resume. Okay, so the airbag mechanism serve to cool down the DLC, and then during this time, the DLC will be cool down for 15 minutes, and then after that, it will benchmark the lowest price in the case of long DLC to see when is to set a new base price, and then then there will be a period of 15 to 30 minutes of observation period to help you to see whether if the market subsequently go down even further, then you will not suffer total loss. So that's the airbag mechanism. So it is quite technical in nature. For more information, you can go to the issue website to download their brochure, or to go to SGX to download their brochure, so that you understand how airbag mechanism work. Now, not to confuse you, just think of airbag like a mechanism to protect you from having a total loss. Okay, so when the market really dropped a certain percentage, airbag was exercised, so it will cool off for a certain period, and then it will benchmark a new rate. So when the new rate come about, then you have reduced exposure in the underlying asset. Okay, now for 5 times single stock DLC, the airbag will be triggered when the underlying asset move against the DLC by 15%. So in other words, you will lose negative 75% if that happens. So the airbag will be triggered if it's the single stock DLC. Okay, if there's underlying asset, if the DLC underlying asset is one stock. Okay. Investors should take note that, however, the airbag mechanism will also maintain a reduced exposure to the underlying asset, even if the underlying asset start to move in favor of DLC after the airbag mechanism has been triggered, thereby reducing its ability to recover losses for investor. Now, because airbags serve to protect you in the event of adverse development against the direction that your position is, then in the event that it go down, let's say you go long, in the event that the share price go down, so you suffer, let's say 75% losses in the allocation that you put in the DLC, long DLC. Then what happened is that after the observation period and the cool down period, if in the event that the share price go up, right, you won't earn as much because of airbag mechanism. It will reduce the exposure, so you won't earn as much. But if you, in the event that it go down even further, you also won't lose as much. That's what it means. Now, for 5 times DLC, in the case of an overnight drop of more than 20%, okay, so or 20% drop within the 15-minute observation period, the DLC would also result in total loss. So that could probably happen. Okay. So now these are the airbag triggered level. So if you have 3 times leverage, airbag trigger is 20%, is much higher. If you have 5 times leverage on index, it is 10%. If 7 times leverage, the trigger is 10%. Okay, but stock is only 5 times. For index, there are 3, 5, 7. For stock, it's only 5 times. Airbag trigger level is 15%. Okay, so if you, let me recap. If you have 5 times long exposure, 3 times long exposure, if the market plunge 20%, airbag will trigger. If you have a short, index, short the index 3 times, the index have to go up 20% single day, then the airbag will be triggered. Then the stock is 5 times, like the leverage suggests. Now, so your question is, do you have 4 times, 6 times? Answer is no, only 3, 5, 7. Okay, do you have 10 times? No, at most is 7 times for index. Now, dividend for single stock DLC. Now, because if you buy into underlying asset stocks, right? Of course, stocks are bound to give dividends, or they are bound for corporate actions such as a stock split, such as bonus issue, okay, rights issue, okay, private placement, okay, share reverse stock split. So there are a lot of corporate actions that can happen to any stocks. So, and DLC will totally account for all these corporate actions, okay? So the DLC takes into account normal dividends of underlying stock in the leverage strategy. As such, on the ex-dividend date, the performance of the long DLC will not go down by the dividend amount, and the performance of the short DLC will not go up by the dividend amount. So no announcement will be made with respect to normal dividends declared for the underlying stock. Okay. Now, for example, if the closing price of the underlying stock before dividend on the T day is 102, okay, now this before dividend is declared. The price is 102. Then the dividend given declared is $2. And then the closing price of the underlying stock after dividend on T plus 1 day is 103. So does the share price go up by $1? No, actually the share price go up $3. Why? Because you got the theoretical price after ex-dividend should be 100. Because you take 102 minus the dividend, so the intrinsic value, the value should be 100. So actually the share price go up by $3. Okay, you get what I mean? Okay, $100. So the share price go up by $3. If the share price go up by $3 versus the real closing price 1 day earlier is 100, because you got to X the dividend. So actually the share price go up 3%. Okay, go up $3, go up 3%. So if you have a 5 times long DLC performance, you will get 15% gain. Okay, remember it's 3%, not 1%, it's 3%. Okay, 3% times 5, you get 15% gain. Airbag trigger level on T plus 1 day will be based on $85. Okay, if the share price from $100 go down to 85, the airbag triggered will happen, because remember for stock 1 is 15% is airbag triggered. Okay, now is everybody clear? Okay, raise your hand if everything is okay. All right. Okay, there are 20 of you raise your hand. Okay, awesome. So I guess everything is clear. Now remember, so the point here is that the dividend and the corporate action is all accounted for. We're going to calculate the theoretical X prices. Now, this is a very important slide that you must know. Okay, must remember compounding effect. A DLC has the same exact compounding effect like a leverage and inverse ETF. Now, the difference between DLC and the ETF, leverage and inverse ETF, is that the DLC is constructed using exchange traded notes, whereby it's in the note form, whereby the ETF or inverse ETF is constructed in the fund form. Okay, it's a fund form. FUND, fund. So these are the difference. And because of that, ETF could have tracking errors, whereby DLC has no tracking errors. DLC 100% accurate. Okay, no tracking error to the underlying. So that's the beauty about DLC. And like using exchange traded funds technique, which also has compounding effect, DLC also has compounding effect. Okay, let's study compounding effect. What do I mean? Now, remember, DLC are designed to deliver leverage performance on a daily basis. Now, this one, we highlight it for you and bold it for you and red color for you. It is what? On what kind of basis? Daily basis. Okay? So the performance aim to give the percentage performance, the leverage is on daily basis. So if you stretch over a longer period of time, it may not be able to perform like what the leverage suggests. Okay, so and the exposure of DLC is reset at the end of each trading day. If you hold DLC for longer than 1 day, your cumulative return will be totally compounded. It can work in your favor or work not in your favor. Okay, so I dissect the different scenario for you. The overall effective leverage could deviate from the leverage factor of the corresponding DLC. Now, one thing I want to highlight here. So you see, if 3 times, it give you, if you do 3 times leverage from day 1, day 2, it will give you 3 times. Day 2 to day 3, it will give you 3 times. Day 3 to day 4, it will give you 3 times. It's not like cumulative return, it give you 3 times. So that's the idea. Now, DLC are not meant for long-term holding. Okay, so this one I have to repeat one more time. DLC are not meant for long-term holding. And important thing I need to say 3 more times. 3 times. DLC are not meant for long-term holding. If you hold it long period of time, the performance could actually deviate from the intended leverage outcome. Okay, let's study. What is the difference? If you see this underlying, let's say, so there are 2 scenarios here. You see on the left of the screen, you see that there's a trending scenario. On the right hand side of the screen, there's a volatile scenario. So if you look at the trending industry, trending underlying, you see that the 100, let's say the underlying is 100. This is a DLC which gives 7 times leverage for long exposure. 100 plus 1%, it becomes 101. Straightforward, right? And then on day 2, it go up 2%, it becomes 103.02. And from day 2 to day 3, it go up 1%, it becomes 104.05. Okay, so total up is how many percent? 4.05%. Okay, and then for 7 times DLC, which is priced relatively cheaper, is $2.50. Okay, so you see, you don't have to, you can buy it a slightly cheaper price to get 7 times exposure to the underlying. Some of you may feel that this stock is very expensive, so you can buy, you can one good thing is you can buy a cheaper one to get the exposure that you need for the underlying. Now, 250, because you go up 1%, so 7 times it go up 7%. So from 250 you go up $2.68. Because it go up 2%, so you got times 7, you got 14%. So 268 go up 14%, become 305. Because on day 3, you go up 1%, so you got the DLC go up 7%, so you get 327. The underlying cumulative return for the past 3 days is 4.05%, but the DLC performance is 30.52%. Okay? Now, if you take the cumulative return, which is 4.05% times 7, you don't get 30%, you get 28% only. You get what I mean? Is over a longer period of time, the cumulative return is not giving you 7 times leverage. Okay, it will deviate from the 7 times leverage. In this case, if 7 times 4.05, by right, it should give you 28.2%, right? But actually, in reality, no. Why? Because there's compounded effect. Because each day it got compounded, it got compounded, it got compounded. That's why in a trending scenario, a DLC can give you a return that is slightly more magnified by the intended return of 7 times. So this is probably 7 point something times. So is it clear? Let's look at another scenario, which is volatile market. Okay, in a volatile market where the underlying is up 2% one single day, down 4% another day, and up 6.26%. Okay, so it's $100 up 2% become 102, minus 4% become 97.92, then up 6% it become 104.05. So you see the cumulative return is still the same. Okay, 4.05%. At the end of day 3, the underlying in scenario 2, the value is exactly the same with the value in the trending scenario, okay, which is 104.05. Let's study the value of DLC. $2.55 Sing dollar, up 2% is up 14%, so 285. Okay, and then down 4%, and then times 7, you are actually down 28%. So 285 down 28% become 205. On day 3, the DLC, because underlying up 6.26%, so times 7, you get 44%. So you become 295. So the cumulative return is also not 4.05% times 7. It's actually much less than that. Okay, it's 18%. So compared to here, you see the underlying asset at the end of day 3, the value is the same. But the DLC at the end of day 3 is vastly different. This is $3.27, this is $2.95. Why? Because compounded return work against your favor. Okay, because there's negative 28%, so it did not work in your favor. So what you can sum up is that the compounded return impact work in your favor in a trending market. It's a strong bull market or in a strong bear market. If the market is volatile, the intended return is not 7 times. Okay, but then the intended return of the compounded return will actually work against you. You see what I mean? Okay, because it's much lesser. Even though underlying price is the same, underlying asset price is the same, but then your return is much lower because in a volatile market, the compounded return will not work in your favor. That's why I have to stress this one more time. The daily leverage certificate is not intended for long-term holding. You hold for 1 year, right? Chances are you will see that you lose money. So let me illustrate for you one more time, okay? And a few more times, okay? In a trending up market, if the deals, so let's say the daily performance of asset 1% got 1%, DLC, let's say this is a 7 times long DLC, we're up 7 times. Then if it's down, second day down 0.5%, so the DLC lose 3.5 times. The third day up 1.5%, is up 10.5%, up 2%, DLC is up 14%, up 2.5%, DLC is up 17.5%. Cumulative return for the DLC, for the index, for all this, right? The index will actually, for the day 5 cumulative return is actually 6.6%. What about DLC? DLC cumulative return, you see, in the trending market, is actually 52.8%. It is much bigger than, you take 6.6 times 7, you get 44% only. Okay, but because it is in a bull trending market, so the cumulative return for this underlying asset, right, and DLC, right, is actually 52.58%. You get what I mean? So you get slightly more than 7 times because of the compounded effect. If it's trending down, okay, let's say you go long. If you go long, when you are trending down, you actually get the direction wrong. You get the direction wrong, definitely you lose money. So let's say day 1 you lose underlying lose 1%, DLC lose 7%. Day 2 underlying lose 1%, DLC lose 7%. Day 3 lose 1.5%, DLC lose 10.5%, and so on and so forth. Okay. And for the cumulative return of 5 days, index actually after 5 days, cumulative return is actually lost 7.8%. But the DLC actually do not lose as much, you know. By right, if you take 7.8 times 7, right, you get 50%, right? You do not get 50% losses, but you only get 45.1% loss. Because why? This time the compounded return also help you a fair bit. Okay, because as the price get lower, right, the percentage of the new base price get lower. So that's why the cumulative return is actually much lower than 7 times 7.8%. Okay, so you see what I mean? So in a trending down market, the compounded return will help you to relieve the losses a little bit, okay, if you got the direction wrong. How about in the volatile market? Okay, let's say it is up, index is up 1%, underlying is up 1%, DLC up 7%, down 1%, down 7% on day 2, up 1.5%, up 10.5%, and so on and so forth. Okay, cumulative return for the index for the last 5 days actually is up 2.4% only. Okay, 1%, 0%, and so on. So cumulative return for 5 days, right, actually up 2.4%, like you can see. Okay, so what happens to the cumulative return of the DLC? 7% and so on. Until day 5, the cumulative return for the DLC is 14.4%. So you see, this is also not 7 times. Okay, so in a volatile market, when it's go down, go up, go down, go up, it is not 7 times. So I mentioned many times already. DLC give you daily leverage, fixed daily leverage that's precisely the same. Okay, before fees and costs. Okay, after fee and cost, then you change a bit. Before fee and cost is definitely the same, but then cumulatively, it will not be the same. So if you expect the market to be very volatile, then don't hold it overnight. Okay, don't do the intraday trading. If you feel that it is a long, is a super bull or super bear, then you can go long or go short and you can hold for a period. That's how you can use these structured products in your advantage. Okay, let me recap. This is very important. If you expect volatility in the ensuing weeks, don't hold it overnight for too long. Okay, do a day trading, buy, sell, buy, sell, buy, sell. Okay, so that the volatility, the leverage given to you is exactly right. Okay, because in the volatile market, you will hold too long, right? Then it will erode the value because of the compounded effect. It is a mathematic thing. It's not the product itself got problem, but it's the mathematic thing. Okay. But if you expect it's a strong bull trend, okay, maybe a 1 or 2 day down, and then you expect strong bull trend, or you expect strong bear trend, then you can go short or go long according to your view. You can hold it over a period of maybe 2 weeks, okay, to get, and then you will see that the compounded returns effect work in your favor. Okay, you will magnify a fair bit of your return. So that is what a DLC is all about. Okay, now I think I spent 60 minutes. Yeah, this webinar is 75 minutes long, so we have 15 more minutes. If I look at my watch, we have 12 more minutes for question and answer. Okay, now before we go to question and answer, right, I have to help you to find how to find DLC on Kentrade platform. Okay, now where do we find DLC on Kentrade platform? Now, if you go to Kentrade, right, this is my account. Okay, now for all Malaysians, right, of course, if you go to Kentrade, the default is you will go to Bursa page. Okay, this is the Bursa page. Okay, now what you need to do is you go to click here. Of course, you have to go to IE. Now, Kenanga platform, because powered by the Excel Force, it works best on the Internet Explorer. So you drop down menu, you click Singapore Exchange. If you go to Chrome, you might not be able to find this. You might not be able to find Singapore Exchange. So you need to use Internet Explorer. You go to Singapore Exchange, so you see all the Singapore stock come out already. Okay, all the Singapore stock. Then you go to search DLC. Okay, you click enter, search. See all the DLC product come out. Okay, now how to read this thing? Now this is a stock code, CISW. The stock name is DLC SG. SG stand for it does not stand for Singapore. It stand for SocGen. Okay, which is the issuer. 3 times means 3 times leverage. Long means long or short. So this is the product. Okay, HSC 2714. Okay, so on that day it's down 15% because long. Today market is pretty bearish, right? So it's down 15%. So this is single stock. Okay. So this is Hang Seng Index. Okay, so If you feel AIA, you see, DLC 5 times long AIA. Today AIA is down, so that's why if you long AIA, you actually down 20% today. Okay, so this is, you see, all is down because why today is pretty bearish. Now, so when you come to short, right, you see, wow, all green already. Okay, up 20%, 20%, 20%. You see, the return could be very huge, right? 20%. So that's why if you don't have a heart of steel, don't go too big. So when it comes to short, now, so these are the 50 DLC you can see. Then of course you can go to the next page to find the remaining DLC. Okay, you see all the short one, okay, is here. Okay, short, all is up 40% and so on. Okay, all this long one, long 7 times, of course lose money. Okay, so this is how you can find. Of course, if you want to buy and sell, just click buy and sell, like how you operate a trading platform. Now, of course, if you are not with, if you don't have an account with Kananga, you can also trade DLC. So long that you have a brokerage account, your broker provide access to the Singapore Stock Exchange. I guess most broker in Malaysia will provide access to a Singapore Stock Exchange. Okay, just go to your respective broker platform to find the DLC. Go to the search and find DLC. There are 97 DLC listed on Singapore Stock Exchange. There are majority are stock based, and then some in index. Okay. Now, out of the, I observe out of the liquid volume, right? Most traded one, most popular one is short. Most people, there are about 70% of people who trade DLC, they trade the short one. It means they buy the short one for hedging. There are 30% want to get a bit more greedy, they want to get magnified exposure, they buy the long one. Okay, but more people trade the short one. There's 30-70, I would say. 30% of people buy the long, 70% buy the short. Most people prefer 5 to 7 times. 3 times is very 3 times not many people trade, but of course liquidity is still there because market maker is around. So that's how you can find. I use Kentrade as an example because number one, I'm a Kentrade client. And number two, because this webinar is sponsored by Kentrade, so we got to show their platform. Okay, now because, okay, wait, let me go back to my slide. So I have covered how you can find DLC. So all in all, I cover what is DLC. I've covered where to find DLC. I cover how you can trade DLC, and then when you can trade DLC during the trading hours, and then who can trade DLC I haven't addressed. Now, who can trade DLC? Okay. Now, DLC is not for everybody. If you are very conservative, okay, up 20%, up 5%, you're very, or down 5%, you're very stressed already, and then of course, it's not right for you. Okay, DLC is mainly for people who are advanced. I mean, who have knowledge about structured products, who know exactly the impact, what I explained to you, the leverage impact and the compounded effect. And it's for people who are speculators, traders, or people who know how to use it for hedging. For more advanced investors who know how to use these structured products for hedging. It's not for people who are very conservative and cannot take the leverage. So of course, I don't want you to get into leverage product and then you cannot sleep at night. It's not right. Okay, so you need to pick the leverage that's right for you. If you're very conservative, then this is definitely not right for you. But if you want to attempt to know what it is, then allocate just like maybe 1% or 2% portfolio to go and see and learn. Okay. Now, when I first started trading and using structured products for structured warrants, right? Then I also use with smaller part of portfolio for me to test out the impact, the implied volatility, and the time decay. Okay, for me to check where is the effective gearing and so on. So if you want to test, of course, by all means, go ahead, but don't use so much. Okay, of course, if you don't have a big heart, then give a smaller portfolio and go for 3 times leverage on index. Okay, don't go too big, otherwise it will affect you emotionally. You don't want stock investing or stock trading affect your quality of life. Don't do you? So this is my idea. Now I come to a question and answer session and some poll session. Now before we take on questions, right? Let's do some poll for some fun. Okay. In the meantime, you can write down your questions. Now I'm launching a poll right now. This is a quiz you to see whether you are paying attention or not. Okay. Question number 1. Now, which of the following can help you hedge your portfolio in a bear market? It's a multiple choice questions. Okay. You can pick. Okay, is it number 1, long 5 times DLC or short 5 times DLC, or is long 5 times DLC or short 7 times DLC? Okay, if you want to hedge your portfolio in a bear market, okay, what you should do? Should you buy long 5 times, short 5 times, long 7 times, or short 7 times? Okay. Then question number 2, which of the following is the advantage of trading DLC, okay, not GLC? Is it no implied volatility impact, no margin requirement, no time decay, transparent, or all of the above? Now, question number 2 is a single choice answer. Okay. After you answer this quiz, then we will, go to a Q&A. I have 5 more minutes for question and answer. While I will do my best to answer your question. Okay, there are 40% of you voted. Let's wait a while more. Okay, more than 50% of you have voted. Okay, I give you the last 5 seconds to pick your answer. Okay, now 1, 2, 3, 4, 5. Okay, so we'll end the poll right now. I will share the result. Okay, are you seeing the result right now? Okay, the answer for the first question is, if you want to hedge your portfolio in the bear market, because it's bear market, so you expect the price to go down, you will go short DLC. So 46% of you got it right. Short 5 times DLC index or short 7 times DLC index. Okay, it's multiple choice questions. So while 7% of you got it wrong, okay, you actually need to go short. Okay, now question number 2, which of the following is the advantage of trading DLC? Okay, the answer is all of the above. So majority of you get it right. Okay, 69% get it right. Because for DLC, there's no implied volatility impact, no need margin, no time decay, and it's very transparent because it's traded on exchange. Okay, so well, majority of you are paying attention. So now let's go to question and answer. If any question, let me know. If I can address any questions. I hope that I do a decent job to share with you what are the advantage and what are the product feature of this DLC that's listed on the Singapore Stock Exchange. Wow, no question. Means that I must have done a pretty good job, or you guys are sleeping. All right. Question number 1, could you share your Facebook account or contact information? My Facebook account. Okay. Let me type for you. This is not DLC relevant, but let me type for you. Okay, you can go to facebook.com/ShaneChu7. Okay, to find me. Okay. Okay, I have answered. You can go to Facebook to find ShaneChu7. That's how you can find me. How much per trade it will cost? The question is how much per trade it will cost. Of course, it's I've covered it in one of the slides. Let me find back the slide for you. Just give me a minute. Cost. Okay, let me repeat. Okay, how much cost? Trading access fee charged by for DLC is 0.001%. Okay, it's much lower than stock. clearing fee is 0.004%, much lower than stock also, and then brokerage fee determined by a broker. That one you gotta charge you contact a broker. Whether if you use a Singapore broker or you use a Malaysian stock broker, then ask them what is the fee charged by a broker. Okay, for the issuer would charge you is in the B and us, and is if you hold it overnight, then these are the costs that you pay, which is very minimal. Okay, not a lot. Okay, so it depends on your size, huh? What is the minimum lot to buy DLC stock? Okay, well, I guess minimum is 1 lot. Okay, for people asking why now Bursa no more webinar. Okay, of course we have webinar for you. Wait for a while more. Okay. Is there a recording for this session? Yes, the recording will be available for you, I guess, tomorrow. So you will receive it in your attendees email, or even if you can't attend, you do register anyway, you'll be sent to your email as well. Of course, there's only about 14 days period for you to view this recording after it is uploaded. After 14 days period, we will take the recording down, but you can find, I believe you can find this video at Kentrade website. So contact the Kentrade. Kentrade means Kenanga lah. I think if you have to be Kenanga client, okay, before they can before I can log in to watch lah, I believe. Okay, if you're not Kenanga client, maybe it's time for you to open an account. Okay, advertisement time. Is there any more question? All right, we have past the time now. We only have okay. We only have 4 questions so far. Means I must have done fairly well, huh? to answer all the questions. So hope that today you understand what is daily leverage certificate. But don't go away yet. There are some announcements that we need to make. Of course, there are more questions. You can keep the question coming. I will still take your questions. Now, next webinar. Okay, now for our next Kenanga webinar, we have money in trends. Okay, it's a topic on how to make money in a trending market, how to use trend strategy to make money. Okay, it's happened on 26th of March, which is 2 weeks from now. It's Thursday, 8:30 to 9:45. For Kenanga webinar, it's 60-minute content and 15 minutes Q&A. We keep it brief and concise for you. Let me share with you. Wait, where is my chat box? Okay, I will share the link for you later. Okay. Okay, I'll share the link for you later. Let me resume a slideshow. So you just go to the link, and then for those of you who are not Kenanga account yet, now we have a good news for you. We have an account opening freebies. So if you decide to sign up for Kenanga trading account, they will reward you with 2,000 B points. So what this B point means? So when you sign up an account with Kenanga, they will give you a Kenanga card, and the card you have they will load it with 2,000 B points, where you can use it to redeem some freebies. Okay, to redeem maybe enrich miles with Mars and so on, and Starbucks. Okay, so you can use these points to redeem. Okay, so these are the bonus for account opening. Now, how you can sign up an account, you can please send your full name and contact number to the email address below and indicate Kentrade webinar. Okay, so go send an email to ebis.kentrade@kenanga.com.my. Okay, ebis.kentrade@kenanga.com.my, ebis.kentrade@kenanga.com.my, and in the email subject, just write Kentrade webinar. You indicate that what is your name and you want to sign an account. You just contact them. Their dealer will contact you for account opening. Okay, the friendly dealer will contact you for account opening. Once account is successfully opened, then your 2,000 B points will be credited to your card. Okay, where you can use it to redeem stuff. Okay, in your favorite merchant. So, and then last but not least, okay, I want to thank all of you for tuning in to this webinar to understand this little known structured products called daily leverage certificate, which is only listed in SGX in Asia as of now. Okay, and there are 97 DLC available in SGX issued by SocGen. Okay, it is a European company. So let us know your feedback. It's very important that we want to know whether I do a good job or not and how much you understand DLC. So this is the survey link for you to give us the feedback. And the survey link was already inside your reminder email. Okay, it was already sent to you in the reminder email. If you feel that I do a good job, then if you feel that the subject matter presented to you is understandable, and the speaker do a good job, of course, give us a good rating. If you feel that I do a bad job, okay, then you tell us what we can improve. Okay, give us a feedback. Please go to your, you can find the link in your email. Okay, let me see if I can send you here. Okay, let me try to send you the link here. Okay. Okay. Well, I can't find by chat box now. All right. Okay. Okay. All right. So I can't seem to send you the link at the moment, but no worries. You can find the email. You can find the survey at the email, which was sent to you in the reminder email. Please fill out the email, fill out the survey that I sent to you in your email. And then for those of you who want to open an account, please go to ebs.kentrade@kenanga.com.my. And if you open an account there, you can get a freebies. Okay. For those of you who are rest for the next week, 2 weeks later, the webinar, please join our webinar 2 weeks later to learn how to make money in the trending market. With that, thank you very much, everybody, for tuning in today. I wish you the best in trading. Of course, the market is very volatile now. Please be careful. In April, we have more speakers to tell you the market outlook. Okay, with that, thank you, everybody. Okay. Okay, it looks like I can only share with you once I stop sharing. Okay, bye everybody. Thanks for tuning in. If you are still here, you can click the survey form that I sent to you, and then the next webinar link are all here.